In this episode, we are going to talk about continuation. I will explain why they happen and how you can identify high probability continuation setups instead of chasing risky reversals. So let's get into it. The first step to any continuation trade is establishing a clear point of reversal that will begin the continuation move. Looking at the chart on the daily time frame, the first thing I do is allow Monday to complete without taking any trades. That is part of my protocol. Monday often sets the tone for the rest of the week, so I want to see how price behaves before forming a directional idea. When I look at the chart, it is clear that the market is currently trading inside a range. A clear point of reversal has not yet been established that I can confidently trade a continuation from. If you look closely at the price action, there are failure swings off the lows and also failure swings off the highs. That tells me the market is neutral at the moment. Neither side has taken control. In this type of condition, the first thing I do is mark the external boundaries of the range. I mark the external low and the external high. Once those levels are defined, I am looking for one of two things to happen. The first scenario is a manipulation of one side of the external range. If price sweeps one side of the range and then confirms a reversal, that sweep becomes the point of reversal. From there, I can look to trade expansion toward the opposite side of the range. And along that move, I can begin framing continuation entries. The second scenario occurs if price fails to manipulate either side of the range and remains trading internally. If that happens, I need to rely on a higher time frame narrative to determine direction. In this case, I use the weekly profile as a guide to help determine both the bias and the point of reversal for the daily candle. When we look at Tuesday's daily candle, the picture becomes clearer. Price failed to manipulate the external low of the range and instead traded higher. That puts us into the second scenario where the market remains internal, and we need to rely on the weekly profile for context. Tuesday is also not a day that I would normally participate in because there is no clear manipulation of the external range. Without that manipulation, the lower time frames become difficult to trade because you are essentially guessing which internal low might get taken before the market reverses. If the market is going to remain internal, then I demand a higher time frame narrative before committing to a trade. That higher time frame confirmation is exactly what we start to see with the behavior of the Monday and Tuesday candles. Now, when we shift over to NQ, we can see a similar framework but with stronger confirmation. On NQ, price also fails to manipulate the external low of the range before turning higher. But here we see additional confluence that supports trading toward the upside with the opposite side of the range as the draw on liquidity. First, we have alignment with the weekly profile. Monday creates a strong opposing move, and Tuesday reverses that move and begins expanding in the opposite direction. That setup typically suggests a continuation move on Wednesday. Second, Tuesday closes above Monday's down close candle. That closure validates the low as the point of reversal. Once that happens, I no longer need to worry about the internal failure swings. Finally, I can mark the price level created by the structure and use it as the reference point to frame continuation entries on the following day. And that is exactly what we are going to break down in the next step. And just before we get into the continuation setup itself, I want to address something that a lot of people usually ask at this point. You might be thinking, if there is a high-impact news event like CPI on Thursday, why would you even consider taking a trade on Wednesday? Normally, traders hear high-impact news and immediately decide to stay out of the market completely for the entire week. But that is not exactly how I approach it. When I look at the economic calendar, I pay attention to the timing and context of those events rather than avoiding the whole week entirely. For example, in this situation, CPI is scheduled for Thursday. That does not automatically mean Wednesday is off limits. I am still open to trading the day before a high-impact news release, but with slightly more caution. The same logic applies if CPI were scheduled for Wednesday. I would still be open to taking a trade on Tuesday. The presence of a major news event later in the week does not necessarily invalidate the price action leading into it. What I am really focused on is the session I am trading. If I am looking for a trade during the morning session and the major news event is not until the following day, then that news is usually outside the immediate scope of what I'm trading. There are also cases where something like FOMC meeting minutes are scheduled later in the day, around 2 p.m. If my trade idea is based on the morning session and the setup occurs well before that release, then that event typically does not interfere with the trade. So the key takeaway is that high-impact news does not automatically mean you should avoid trading entirely. It simply means you should be aware of it and approach the market with the appropriate level of caution. With that clarified, now we can move on to the continuation setup itself and how the next step is framed. Now that the higher time frame narrative is established, the continuation day itself becomes much simpler to frame. Most of the hard work has already been done during the higher time frame analysis. What remains are the repeatable steps that allow us to execute the continuation trade. Going into the daily open of Wednesday's candle, where I am expecting that continuation to occur, there are only two things that I focus on. The first is identifying where the intraday reversal is likely to form. The second is looking for a bullish daily profile that confirms the idea of continuation to the upside. Earlier, we already marked the daily down-closed candle on the chart, which is expected to support price. But in continuation trades, I like to simplify this even further. I focus on opposing closed candles on the hourly and the 30-minute time frames, because those levels often act as support during a continuation move. So when I look left on the chart at the open of Wednesday's candle, I am specifically searching for recent down-closed candles that price has already closed above. The most recent series appears right here. Because of that, on the open of the day, I am looking for an opposing move inside the daily range that retraces into these down-closed candles. As long as price remains in respect to that area and begins forming a bullish daily profile, that provides confirmation for the continuation idea. At that point, I can begin looking for an entry aligned with that direction. As the daily range starts to develop further during the New York session, I can then review the overnight session and ask an important question. Is the daily profile confirming my idea, or is it invalidating it? Looking back to the left, I again check whether those opposing closed candles on the 30-minute or hourly time frame are still being respected. In this case, price continues to hold that low while trading below the daily open. From there, I can identify the potential point of reversal. Around 3 o'clock, we see a change in the state of delivery, which confirms a London session reversal. With that information in mind, by the time we approach the New York session, we now have alignment for a continuation. That allows me to begin looking for an entry that gets me positioned in the direction of the move, targeting the opposing side of the range, which is acting as the draw on liquidity for this trade. Skipping a few candles ahead, I eventually get the entry signature that allows me to position myself alongside the idea of a New York continuation. The expectation here is that once the New York session begins, particularly around the 9:30 open, we should see the expansion to the upside begin. This is where I took my first position, placing my stop loss just below that low. However, shortly after entering the trade, the market pushed down and ran that low, removing me from the position by hitting my stop loss. I was expecting the market to hold through the open, but sometimes that is the risk you take when trading around the 9:30 session open. Most of the time, the expansion works in your favor, but occasionally the market will sweep liquidity before moving in the intended direction. At that moment, I have to ask myself an important question. Does this stop out completely invalidate the idea of trading this day to the upside? Or do I still have room to reposition myself? Looking over to the ES at that same moment provides the answer. While NQ made a lower low and removed me from my initial position, ES actually made a higher low and respected the down-closed candle that followed the open. That is a clear sign of relative strength in ES. Because of that, I can recognize that the overall narrative for the trade is still intact. Nothing from the higher time frame idea has actually been invalidated. So instead of abandoning the setup completely, I reposition myself with a new entry, once again placing my stop loss below that low. From this point forward, the rest of the trade simply becomes a matter of trade management. The objective remains the same. reaching the opposing side of the range, which is acting as the draw on liquidity. After reassessing and repositioning on ES, that low holds in the market, and we finally see the expansion to the upside begin. This move aligns perfectly with the narrative we established earlier on the daily time frame. Moving back out to the daily chart, you can clearly see the follow-through of this idea. Monday and Tuesday remained internal within the range, but the narrative pointed toward a Wednesday continuation. And that is exactly what we get. A clean expansion to the upside, moving toward the external high of the range, which was acting as the primary draw for the trade. These are the types of price moves we look for in continuation setups. Clear structure, a defined narrative, and a directional expansion toward the opposing side of the range. With that all covered, this is essentially the foundation of how I frame my continuation trades. But before we wrap up, I want to quickly recap the three main things you should focus on when applying this concept. The first step is setting the narrative on the higher time frames. This is absolutely necessary for a continuation trade. Without a higher time frame narrative, the continuation setup simply doesn't work. No matter what strategy or approach you use, you need a clear higher time frame story that explains why the market should continue in that direction. The second step is identifying a 30-minute or 1-hour opposing closed candle along the way. This helps you frame the intraday reversal that begins the continuation move. Once that reversal forms, you are then expecting price to continue toward the draw on liquidity that you previously established. So on the continuation day, you want to use those 30-minute and 1-hour opposing closed candles to frame where that intraday reversal is likely to occur. The third and final step is confirmation from the daily profile. The daily profile should align with the previous two steps and confirm your overall idea. This confirmation gives you the framework and baseline you need to execute your entry and manage the trade properly. When these three things align, the higher time frame narrative, the intraday reversal around opposing closed candles, and confirmation from the daily profile, you have a structured way to frame continuation trades. That is everything I have for this video. I really hope you found it helpful, and I'll see you in the next one.